Good afternoon, everyone. Welcome, and thank you for joining us. My name's David Judas, and I head up intermediary sales and national accounts at Barron Capital. I'm joined here today by several of my colleagues on the investment team, Cliff Greenberg, Co-CIO and manager of the Barron Small Cap Fund, David Goldsmith, assistant portfolio manager on the fund, as well as Laird Beeger and Randy Gertzman, portfolio managers of Barron Discovery Fund. We wanted to talk to you today a bit about small caps, an important part of investors' asset allocation, and a part that maybe was a little unloved lately. And we think there are many reasons that you should take a look at that again and revisit. Too much talk about large caps lately. So this is purely a small cap panel, and these guys are part of the investment engine at Barron Capital, our true competitive advantage to alpha generation. We are going to take some questions after some comments. You can do that in the chat function or questions@barronfunds.com. And there will be a short survey at the end we encourage you to complete for us. We appreciate your feedback, and we appreciate you investing with us. Okay, so to kick it off, I'm going to turn to my colleague, Laird Beeger. Laird, why are small caps so attractive today?
Absolutely. So let's take a little trip back in history and go back to February 2021. Small caps were definitely in favor at that point. It was all the rage. All of us were getting people coming up and talking to us at cocktail parties. It was a good feeling to be a small cap manager at that point. Since that time, we've actually seen small caps significantly underperform. We've been in a 3-year bear market. We peaked at around 1725, and today are down 24 as of last night, 24% from that level. So officially, a 3-year bear market, which is historically a long period of time to be in a bear market for small caps. So it's been a challenging period. It's why I stole Cliff's bumper sticker, have you hugged your small cap manager today, because we all kind of need a hug. On the large cap side, though, you look at what's going on over there. The NASDAQ is and S&P both nearly at 52-week highs a couple of weeks ago. They are up 15, at least in the case of the NASDAQ, is up 15% from where it was back in February of 2021. And so a much different story than what we're seeing in small cap. So, that's the bad news. So let me talk to you a little bit about the good news. For those of you who consider yourself contrarian investors, I want to go through a little bit of an investment case on why today is a good time to be allocating to small cap. So let's look at this first slide. What you're seeing, yeah, you got to go back one. Sorry. Let's look at this first slide. What you're seeing here is actually the cumulative performance of small cap versus large cap. We're the light blue line at the top, and as you can see, this is a 25-year chart. For the first about 22 or 3 years of it, that little light blue line was ahead of the dark blue line representing large cap. In the last 3 years, the opposite has been the case. You've seen large caps outperform small caps. Going back to my earlier comments about the performance of those markets, the reason why you typically see small caps outperform large caps is the fact that small caps, because they are smaller companies and working off smaller bases, tend to outgrow from a fundamental standpoint. So earnings growth is faster, and you would expect as a result that stock appreciation would follow that earnings growth, and therefore you would expect outperformance over a long period of time, as you saw for the most part of this historical chart. So what have we seen in the last couple of years? You've probably all read it in the media. There's been a large piling into large cap stocks, especially the Magnificent Seven, those mega cap stocks that everyone wants to own and that are performing well. But at the same time, small caps continue to be unloved, and it's been a painful and challenging period for us as small cap managers. Let's go to the next slide. All right, so you're probably asking yourselves, how do valuations compare from small caps to large caps? Well, going back in time, if you look at the chart that's going to be on the left-hand side of your screen, you can see where the dark blue line, large caps, are being represented by that gray line. But for the most part, in the 25-year chart, for about 22 and a half years, you see that the dark blue line was above that gray line. And then, of course, in the last couple of 2 to 3 years, the opposite is true, where now you're seeing large caps trading at a premium to small caps. This is really counterintuitive, given the fact that you would think that you would want to reward, the faster growth of small cap fundamentals with a higher multiple, and historically that has been the case. If If I shift you over to the chart on the right, you can see that historically small caps have traded at a 3.7 term premium, PE premium, to large cap, and today we're trading at a 0.9 term discount. That's very unusual, and it is the opportunity for someone that's allocating dollars today, which is we believe we're going to get a reversion to the mean trade, and just simply closing that gap. If earnings were to remain unchanged, but we just went from a 0.9 time discount to our historical average of 3.7 times premium, that would represent a 25% appreciation in the benchmark. So, and that's with earnings being unchanged. Yeah, next slide, please. So the moral of the story is that we do believe that you should take advantage of the fact that valuations are cheap, but we also want to point out how small caps as an asset class tend to be the best place to be coming out of these long bear markets. And I'm just giving you 3 examples here, but I think this current period is very analogous to what we were seeing in that 00 to 02 period, where you had a significant imbalance going back to the late 90s. You then had what was a challenging period for small cap stocks, and then coming out of it, you can see that small caps significantly outperformed large caps. I mean, in this particular example that I'm giving, you see that the S&P was up around 50%, small caps were up 74%, so actually appreciated at a 50% greater clip over that 2-year period. Not to mention, if you were just to look at how the Russell Growth did in these 3 different examples that I'm giving, just the nominal amount here are pretty impressive, meaning 76%, 145%, 153%. These are over relatively short 2-year periods. So I think the point I'd want you to take away with is that if you believe we're going to have a recovery, and as I like to tell our analysts, 100% of economic downturns are followed by economic recoveries, then I think that small cap is a great place for you to be allocating capital to.
Great.
Yeah.
Thank you, Larry. Awesome. We're going to go on to Cliff at this point. Cliff, maybe you could tell us a little bit about our offerings, as well as what's the secret to how we've been so successful finding hidden gems in the small cap space.
Sure, my pleasure, and welcome everybody. Thank you for joining us today. Well, first, just to explain the Barron fund family. Barron Capital has 3 small cap funds: the Barron Growth Fund, the Barron Small Cap Fund, and the Barron Discovery Fund. These are the heritage of our organization. It's where it all started. It's kind of where we focus and where the bulk of our assets are invested. We really do consider ourselves to be, the small cap pros, and these are our offerings. Barron Growth Fund started 32 years ago by Ron Barron and now is co-managed by Neil Rosenberg. Barron Growth Fund primarily invests in super high quality growth companies and runs a very, very tight portfolio with low turnover. The Barron Small Cap Fund was started 26 years ago. I was the founding manager of that fund back then and have run it since. David Goldsmith is my partner in crime and joined me managing this fund a handful of years ago. We try to invest in what we consider to be leading niche small cap companies, and with the goal to hold them for a long period of time as they grow and flourish as businesses and as stocks. And the Barron Discovery Fund was launched 10 years ago, run by Laird and Randy. They're sitting here with me today. They are my former lieutenants and close friends and people I admire very much. Barron's Discovery Fund primarily invests in smaller, at the get-go, smaller companies, and has a deeper focus and concentration on tech companies and healthcare companies, which plays into their investment strengths. So that's what those are our offerings. All the funds have done very, very well over time. If you can see the charts on the right, the dark blue is our performance. The light blue is the performance of the index, and each of the funds has significantly outperformed the index over the long term and over most any period of time. So we're very proud of our long-term approach. We all work together. The different funds really share the same principles and use the same common research group to help us do stuff. We coordinate our efforts. We try to help one another and collaborate, but we do come up with very different portfolios, and the overlap between our funds is pretty modest. All funds, though, as I happily can say, have performed very well over the long term and over most any period you look at. So how do we do this? And no, we'll go back one slide, David, if you don't mind. It's okay. Yep. We our investments are all stem from our internal deep fundamental research. We have listed on this slide is our 45-person research team. Maybe, as you can tell, we have very, very tenured portfolio managers who are experienced and have been running the funds for a long period of time. Many of us have gray hairs, if you look carefully. They're in here. Right, you have it. And when we have this fabulous group of research analysts that we've carefully put together over the last 25 years and trained, and it's organized where people have deep expertise in certain area in the industries that we're most interested in and make our largest investments in. So I do believe that this is a major asset, and the group and is as good, if not better, than it ever has been. So we really have a great group of researchers, and we're all focused on the same thing, meaning we are long-term investors in what we think are special small cap companies. We're trying to look at these businesses over the long term, so try to pretend or act as if we're owners of those businesses, ask questions about where the companies are going to be years down the road, and invest against or into those businesses that we have high degree of confidence will grow to be much larger in time. And if we're successful in doing so, those will be proven to be terrific stocks. There are some common characteristics of what we look for, so let me explain that. So what we find is most all of our investments really share these same characteristics. We're looking for very high quality businesses, so businesses that are leaders in their niches, businesses that have good business models, make high profit margins, have good balance sheets. We think are best in class. We're looking for businesses that have can grow for a long period of time because we're investing for the foreseeable future. Businesses that have durable or sustainable competitive advantage, which is very important. If you're investing over the years, you want to have high degree of confidence that those companies can continue to succeed, if not get stronger over time. People are very, very important to us, and we'll spend a lot of time trying to invest with managements that we believe are visionary, that we believe are successful. Very often, especially in the small cap space, they're the founders of these companies. They have large personal stakes in the businesses, and we're investing alongside of them. And we try to invest in an attractive price, meaning, and that very much matters to us. The best stocks are businesses that you can buy when they're very cheap and nobody knows about them, and you can make money based on the growth, both on the growth of their business and multiple expansion. But we've also been successful just investing in very high quality businesses that grow, and we're buying in at a good enough price that we don't lose multiple over time and give back part of the return. A very simple way to explain this is David and I and the small cap fund typically invest in a business that's about $2 billion in enterprise value, market cap when we go in. We are looking at that company with this thought and hope that in time it can become a $10 billion business. That's what really it attracts us to making an initial investment. It's a lot to say. It's a high hurdle. It's hard to accomplish. But as we'll show you a little later in the presentation, actually many of the companies and the investments we've made have done just that, if not even better. So I think that's a little summary, Dave, of how we go about what we're doing.
Great to get us started. Thanks, Cliff. Maybe we'll turn to a little bit about the Discovery Fund now. Randy, could you kick us off and not only tell us about the fund, but love to learn a little bit about some of these companies you guys say we've never heard of, but we will.
Terrific. Yeah, thanks, Cliff. Nice intro, and David. If you just throw that slide up, perfect. As Cliff mentioned, we were established more than 10 years ago at this point, which is pretty amazing. It's gone quickly. Fund has grown to about $1.5 billion in assets. We have 61 holdings. So that's pretty typical. We're typically between sort of 55 and 65. And our turnover is a little higher than what Cliff does, given that we are a little more invested in some earlier stage tech and healthcare companies. But we risk manage the portfolio, which is one of our unique characteristics, and I'll get into that in a second. Active share 96.4%, and our top 10 holdings are now 28%. We're typically about 30 around there, so it's right on target. The annualized return since inception just about 12.6%, and over 4% alpha since inception on an annualized basis. So we're pretty proud of that, and Laird and I each have our own pretty significant holding in our own fund. So we eat what we cook. Dave, next slide. This chart we love. This is on a 5-year rolling basis. We've outperformed the index 100% of the time. So if you look at any 5-year look back period, that's, it won't necessarily be the case on any given year or quarter, but that's because we're focused more on the long term than the short term. Laird and I like to call this long-term arbitrage. And one of the things I learned when I was in economics major in college was that in the short term, the market is very, very efficient, and it's very hard to make money outguessing people in the short term. There's a lot of information, and as everybody knows, between the availability of information, AI, and everything else, and trading platforms, that's kind of a mug's game. So what we do is we really, as Cliff said, want to pretend like we own the company. I mean, we do own the company, but that we're actually managing the company. Get into the mind of the managers and understand what they want to do and where they're going to bring the company and therefore the cash flows over a period of time. So at the outset, what Laird and I do is we find similar types of companies to what Cliff and Dave Goldsmith look at. But what we also think about is, well, can we double our money in a sort of a 4 to 5 year time frame? Or can we earn a 15% compounded return on our invested capital? That's a combination of the growth of the cash flows and the valuation at the time we invest. One other thing that we kind of do is we call it investing in reverse. So we have plenty of analysts that cover the industries. We want to meet with every company that's a quality company within the market cap of the fund. It may not be the right time from a valuation standpoint to invest in that company. We do our work up front. And one of the things that Cliff sort of taught us when we were under his wing, and we still sort of are, right, is fallen angels are a great area to prospect. So these are companies that have done really well and they stumble for whatever reason, but the thesis isn't broken. If you've done your work up front, you can capture those names at 20, 30% discount sometimes because people panic on the earnings. And then it gives us not only the valuation opportunity, but the liquidity opportunity. So that's a key part of the portfolio. So just the bullet points here, we invest in quality small cap growth companies, seek to double the value. The multidimensional approach to risk that I alluded to before, very important in our portfolio, which has a little more volatility than Cliff and Dave Goldsmith says. We're levered to some higher growth, super high growth companies in tech and things like that. What we want to do is balance the portfolio among industry and make sure we're balanced within the Russell 2000 growth industry classifications for the most part. All of our return over since inception really has been from stock picking as opposed to allocating to different industries. Valuation is critical, as I mentioned before. We're constantly reviewing that. We have 3 different categories that we kind of think about our portfolio: high growth, 20% plus growers, and that's right now about 45% of the portfolio. So when I mentioned it's a high growth portfolio, I wasn't kidding. 35% roughly in growth, and the remainder, which is typically around 20%, is in the category we call other, which kind of special situations like the fallen angels I mentioned before. It could be a restructuring, a spinoff, that sort of thing, or maybe there's an activist involved. So we have a couple of those situations right now. Right now, we're a little more levered to the high growth, partly because of what Laird was talking about, in that we feel there's an incredible valuation disparity in small cap versus large cap. And if we are nearing the end of a rate cycle, and let's all hope that's the case, if we do get into a soft landing situation where, at least if you have stabilization of rates, but even better, obviously, if rates start dropping, small cap will take off, we believe, based on historical, based on what's happened in the past. And that, in particular, some of these higher growth companies will get even more juice. So we've tilted the portfolio a little bit towards that. The co-manager structure is also unique at Barron. We're and I are the only guys who can have been co-PMs, although Cliff and David are as close as it gets. And it's when people talk to us, the one thing they ask us is, how do you resolve problems between you if you have an argument? And I always say octagon. So if anybody follows Ultimate Fighting. In any case, next slide, Dave. Thanks. Just a quick example of one of the types of companies we invest in. It's not a tech company or healthcare company. This is an environmental, industrial, but really cool, small company. We've owned it since the IPO. We've owned it for about 4 years. And what they do is they, as you can see, they provide assessment, analysis, consulting, testing, and environmental remediation services. So they are called upon by Global 500 companies to look at all the properties, make sure that they're in compliance, and when they're not, to build strategies and plans for cleanup. Huge market, $10 billion opportunity. The company's, $600 million. This is 2023, and in 2023 they did about $80 million, roughly, in cash flow. We believe that the organic growth is single digit, but they can put up 15% top line growth. And we think that cash flow that I mentioned was about 80 million in 2023 can grow to over 230 million in 2028. That's kind of the way we view this stuff. Now, obviously, there's a lot that went into that. One of the big opportunities the company has is, in fact, yesterday, the EPA just announced finalization of standards requiring cleanup and maintenance of extremely low levels of these forever chemicals, sort of forever plastics, that we found everywhere in the water supply, and people ingest this, and they are carcinogens, and all kinds of bad things happen. So there's hundreds of just DoD sites. There's thousands and thousands of commercial sites. We believe that starting next year, it's going to be a big boost to revenues. This is already something that grew from 20 million when the company sort of first came public to what we believe is over 100 million now. So almost 20% of revenues. And we believe that there's massive opportunity to go forward. They have some superior technology. So we think they'll get more than their fair share of what could be a really big market. Company trades now about 14 times cash flow, but only 5 times our out year cash flow. So that 4 or 5 years from now, and at $44 a share, it's more than a double when we kind of think about our, applying an exit multiple to our out year cash flow. So that's just in a nutshell kind of type of thing that we look at, and neat little company.
That's great and timely, insightful example. I was going to ask you if I should throw out all my non-stickware, but thank you very much, Randy. Right. I think maybe we'll do the same, a little dive into Barron Small Cap. I'm going to turn it over to Dave to get us started.
Yeah. Let me start, and then Cliff, please fill in. Sure. So Barron Small Cap Fund was started in September 1997, 4.8 billion in assets. We typically have less than 75 stocks. Today, that currently is 60, with a low turnover, 14%, and a high active share. The top 10 is usually 30 to 40%. You see now as we're running a little bit above that because our highest weighting names have done extraordinarily well. So that's a good thing. And I'd like to point out that we've made 10.5% annualized since inception. That's 5% better than the index. And after 25 years, that adds up a lot. So that's great. And I'd like to say we've beaten the index 6 out of the last 7 years. And on any time frame, 1, 3, 5, 10, we've also done better than the index. Last year was a great year, and we're off to a super start also in 2024. What I think Cliff and I are also proud of is this performance has done at a lower risk profile. And you can see that in our upside downside capture if you look at some of our marketing materials. So that's kind of my spiel, if you don't mind. Cliff, take us through.
Yeah, just add a couple of points. If you don't mind the next chart, David.
Sure. Yeah.
I just want to, as I mentioned, as far as what we're hoping to do, we truly are long-term investors. The slide is pointed towards that. If you can see that we've held in the portfolio of our 60 stocks, 15 of those we've held for 10 years or more, and another 17 stocks we've held for anywhere between 5 and 10 years. the average return on kind of both those buckets of stocks is over 20% a year. So we really eat our cooking in saying that we're hoping to find stocks that we can own for a long period of time, and if we find the right ones, they can perform very well for a long period of time. Next slide, Dave. Thank you. And then the other thing, and this is something we're very, very proud of, as I mentioned before, we're trying to find small companies that can become much bigger, and with the belief that those stocks can be fabulous stocks over time. This chart shows that we have owned in the fund presently 11 stocks that are 10 baggers. 10 baggers mean the value of that company has increased tenfold or more during our holding period, which is pretty great. 11 stocks are up over 10 times since we've held them. Many of the years we've held them on the right, these are some of our long-term holdings. Anywhere between 7 and 20 years are in this bucket. There's another 6 stocks, I think 6 that are 5 baggers that have also been really strong performers. These are some of these are some of our younger holdings or newer stocks, but have also performed very well. And this actually, the returns on these 5 and 10 baggers have been really sensational, and it's makes up 2/3 of our portfolio that we presently own. We continue to believe there'll be great stocks from here, or we wouldn't own them anymore, or own them in the size we do. And it really is has been the reason and the basis of why the fund has outperformed over time, because we found some great stocks that we've benefited from over the long term. So let me go back to you, Dave, and give for you to kind of give an example of a new stock that we're recently purchased. And we're hoping that one day this company will be on that chart of one of our long-term successful holdings.
Yeah, great. Thanks, Cliff. So the company we're profiling here today is a company called Intap. It's a $32 stock at $2.5 billion market cap. What we look for is strong management teams with proven track records. This company was founded in 2000. The CEO has been there 17 years, owns 7% of the stock. The chief product officer is the co-founder, is still there. And this company was bootstrapped from the beginning until they IPO'd in 2021. They didn't raise any money until then, and have grew the business to 400 million in sales. So pretty impressive. What does Intap do? Intap is a mission-critical cloud-based software platform for law firms, consultants, investment banks, private equity. The who's who of these industry are clients, as you can see on the slide: Kirkland & Ellis, KPMG, Goldman Sachs, Carlyle, Raymond James, and they use this software to clear conflicts for new arrangements, onboard new clients, record billable hours through AI. They establish regulatory walls. So they're using this software and this platform like we would use our Bloomberg terminal every day. They have a sustainable competitive advantage, which we're trying to depict here in the middle right with those nodes. This is a software that needs to manage a complex ecosystem where there's multiple relationships or connecting points on deals or transactions with many partners and bankers involved. And the software is tailor-made over 20 years, made by bankers and ex-consultants for this industry. That's the key here, is what software companies are trying to do for their clients are improve efficiency. Intap reduces onboarding and client acceptance by 20 to 50%, and they reduce revenue leakage through recording billable hours to increase revenue. So that's what these companies are looking for their vendors to do. Intap has that advantage to do that and proven over many years. They also partner with Microsoft. This company was doing AI before it was in vogue, so they're incorporated into their product. The relationship with Microsoft is critical because a lot of these law firms that are clients are heavy Microsoft users already, so there's an inroads there. And Microsoft salespeople can reduce their quota by selling Intap, so it helps them bring up new clients as well. I like to say the proof is in the numbers. This is 97% gross retention, meaning this is once you're on this platform, you stay on this platform. 60 customers are spending over $1 million, and they've displaced in our research Salesforce, the OK product, 500 times. And then what I think is most valuable is customers that have been on this platform 9 to 10 years. So the oldest cohorts are still growing. The last 3 years, those oldest cohorts have grown 18% over the last 3 years, meaning they're still finding value in Intapp's platform and new products that they're bringing to market. This business has a long runway of growth. The last 3 or 4 years, they've grown 23% annually. We think that can sustain and grow 20% over the next couple of years. They're adding 50 logos a year. So that's 50 logos a quarter, so 200 logos a year. And this is a huge market if you think about the global TAM of banks, consultants, private equity, private credit. They have an opportunity within their existing 200 top accounts to add $1 billion of cross-sell and upsell as they bring new products to market. And as you transition from on-premise to the cloud, which this company has done, 75% of their revenues are already in the cloud. The remaining, as you move to the cloud, usually spend a lot more. So you're getting these 3 legs of growth over new customers, upsell, cross-sell, and this transition to the cloud. The margins on this company are 11% free cash flow. We think there's a great opportunity to grow that 3 to 5% a year to be 25%. So when you fast forward this business doing $400 million of sales today, $2.5 billion market cap, we think this is $1 billion revenue business doing $250 million of free cash flow. And to us, that's a business worth 3 to 4 times its current value. So exciting that we're finding these opportunities. Yeah, exactly.
It's great. No, let's keep talking here. I think we have a lot of questions I want to get to. So I'm going to just stop us there for a second and say, and try to put these into a common framework because there's so many. But I think generally speaking, I've seen, what are you hearing from your companies? They want to, clients want to know from you guys. We're in the market all day long talking to these companies. What are you hearing about the economy and about how their businesses are doing? So whoever wants to start.
Sure, I'll start with that, Dave. Well, first of all, it's a little different than what you're hearing on CNBC every morning. What we're not hearing is that the economy is super strong. We're not hearing that inflation is really sticky. We're not hearing that employment conditions are really tight. Actually, just the opposite. The economy is resilient, but just growing modestly. That most companies feel like inflation is really behind them, and that it's easy to find employees, even though there's not a lot of turnover because you don't want to give up the good ones you have. But we're not in the situation we were a couple of years ago where you couldn't find employees or had to pay up for them. So it's a different, and honestly, our view or understanding of what's happening out there in the world is better when we listen to what our businesses are telling us than what maybe a talking head would be telling you and what these big economic statistics. Our takeaway from all of that is in essence that we believe that interest rates will decline because inflation's coming down and the economy is not so robust that it needs to stay high. We believe actually that business is set to rebound after a couple of years of underperformance. We believe the growth rates of our companies and their earnings outlooks are going to accelerate. And we believe, that's actually really a good setup. Laird was touching on this for stocks, that if rates come down, which are good for stock multiples, and businesses do well and their earnings accelerate, combination of better earnings outlooks and, a better earnings growth in the future than we've had the last couple of years, higher multiples driven by lower rates and also by relative underperformance or undervaluation of our asset class sets up for something that we feel like we're in the front end of a good run in the small cap space.
Great. Should we touch on AI a little bit? There's several questions on this topic, so I'll just put it out there. How are you guys seeing your companies benefit from it? And let's talk about that a little.
I'll take that one. And AI, we're obviously not investing in companies like NVIDIA, which are giant picks and shovels provider. I mean, NVIDIA is like the king of the hill right now. But so many of the companies in our portfolio benefit from AI, and AI is a productivity story. So when people talk about inflation, I just want to make this point. In every period where the economy has been able to grow, where unemployment has been at levels people view as too high, in other words, which would cause wage inflation, productivity has turned the tables and actually enabled really good economic growth without the inflationary backdrop. And so I think AI is going to be one of the factors that gets us out of it. Just broadly, we have companies in cybersecurity that use AI to examine network traffic, billions of data points, and recommend and automatically remediate issues when people are trying to break into networks. AI is used at a company called Axon, which has software from body cams for cops and their taser guns. They can automatically help public safety officers write reports. They can examine what they're working on now. We just met with the company management. Is taking all the data using AI to collate what kind of incident happened from the video feed, and then taking that data and automating crime reporting. So it'll be an objective, massive database. They're going to have the biggest crime database effectively around, other than the FBI. And they're using that in that aspect. They actually have 20 times more video than Netflix, which I think was unbelievable. In any case, and then other companies, we have bioinformatics or biosimulation company called Certara, which actually uses computer software to simulate chemicals for drug development. So how effective are they? Are they harmful, and that sort of thing. So there's many different use cases, and it permeates almost the entire portfolio.
Yeah, and I'd like to add our biggest name in our portfolio is a company called Vertiv, that is a direct beneficiary of this AI boom through the investment in data centers. Vertiv makes thermal and power equipment, heating and cooling equipment for data centers. AI is proliferating the need for more data centers, bigger data centers, more racks, and those racks that use GPUs run hotter. So they need more equipment they need more cooling equipment. Vertiv is a global business that's been doing this for 50 years, has an unmatched service component. So if you are a big hyperscaler or anyone who needs to expand, Vertiv is really one of your first or top choices because of their established credentials in this business. And so this is a business that can grow for many, many years, a top line with an expanding margin profile, and really is just getting going. That stock was up 250% last year, is already up 60-something% this year, and we see still a very bright future because this is just starting.
Yeah, one last thing I was going to say on AI, it is a topic of conversation with every CEO and their board, and it's not just about what's the opportunity, but it's also about what is the threat. And so as we look at every single one of our businesses, and it can be something really mundane, such as an industrial manufacturer or even a casino, every single company is trying to figure out how they can use it, how it's going to help them be more productive and grow their business. But it's very early days, and it's kind of like the internet in the 90s, where we don't quite know where it's going to take you, but there's going to be winners and losers. And I think something you can feel confident about is, as active managers, we're really digging into these issues. If you're a passive strategy trying to figure out how AI is going to impact individual companies, it's not going to be easy, but we really are spending a lot of time talking with our CEOs to figure out just that.
Great. Excuse me. So it looks like we have a question on IPOs. That market seems to be coming back after a couple of years, is the general sense here in the question. Is that good or bad for you guys?
That's great for us.
Yeah.
Honestly, it's been years. I mean, forever and ever, all of us collectively, we're kind of big fish in a small cap space. So any company coming public is going to come and see us, and we'll get a first look and in those meetings, we'll get a sense does this company meet the criteria that we're looking for to be an investment? Over the last couple of years, and it's been often a source of many new ideas for the fund, and lots of our big winners came from us initially making an investment in its company when it came public. There really haven't been any IPOs over the last couple of years. Financial markets have been shut, and that all is changing. And over the last year or two, there's been a lot of what we call testing the water meetings, where a lot of companies who are considering or hoping to go public have come in to meet with us and are trying to incite or interest us investors to being part of an IPO. And now actually those companies are coming public, and we're had a meeting yesterday and something that's very exciting, and we're back. And also what you find is when the IPO market has been in a logjam for a long period of time, the first companies that kind of come public are really the best companies. Very often those companies are also coming public at good valuations, and therefore, we are really excited about this being a great source of new ideas. You guys have had good
Yeah.
success so far here too,
Yeah.
right?
Yeah, we've already, so in Q1, we can talk about, we invested in 2 IPOs, small because the prices of the companies went up so much in the aftermarket, but we bought a little bit of a company called Reddit, which is a community-based social media company, which we think can grow pretty dramatically. In fact, their data is being used to train Google's AI under a big contract that they got. So that's something that's exciting. And then another company called Astera Labs, which is a semiconductor company that does communications chips effectively, both onboard, so chip-to-chip communication, and then server-to-server communication to speed the flow of information for AI-enabled servers. So tons of stuff, as Cliff and David said, more companies are coming in every day. And we've also been doing a ton of what they call testing the waters meetings with private companies that are maybe 3 to 6 months before. We've seen a couple that we are really excited about that we think will be coming to market over the next quarter or two. So it's active and fun.
And our
It's
reputation
fun.
in this space really does enable managements to come see us and open up their businesses to us so we can understand them better. They would like to partner with people who have own a company, not rent the stock.
Great. So you guys touched on a few things. There's questions about, Cliff, you mentioned valuations, and I see a question about, hey, you talked about large versus small. How's about just absolute valuations of small caps?
My take, and everyone put their 2 cents in, is beginning of last year, the absolute valuations of the stocks we owned were very, very cheap, either expecting that the market was going to stink, we were going to go into a recession, or these companies would not hit the earnings estimates that we expected them to do. And last year, most of our holdings did well, and the stocks did very well too. And the stocks, last year's increase in the price in our stocks got those valuations back to what we think are reasonable levels, not expensive, not cheap, but proper, maybe on the cheapish side. From here, as I kind of said before, we're kind of expecting and hoping and expecting that growth rates revert back to historic levels, which are faster than present, and lower interest rates, both of which mean that even though stocks aren't screamingly cheap on this year's numbers, we do expect multiples to expand, and we also believe that these companies are going to grow for a long period of time. So when you look at their multiples a few years from now, the stocks are super attractive.
We're seeing pockets of real cheapness. Medical devices is one area, even in the backdrop of some M&A where our companies are getting taken out. So, Shockwave was one. We don't own Shockwave, but that was a recent deal that was announced by J&J. And we got a company that's in the process of being bought out by Boston Sci called Exonics. So that's really exciting. And I think actually software is cheap now because in last quarter when they reported kind of blowout Q4, they gave guidance for the full year of 24, which was sort of in line with what people were expecting. But the whisper, people were hoping they would raise numbers. Companies are being conservative. They want to see how the economy plays out. It's a great opportunity now to buy, some application and system software companies that trade it down just because people don't want to wait 2 quarters to see how the guidance progresses.
I'd echo those statements. We're finding real value in small cap software as well. Intap is a new addition, and we've added to certain positions in Encino, which does bank operating, loan origination for banks, a software business, and Sprout Social, which is social media management for companies. That trend is certainly, no one's using the phone to make a complaint. They're using Twitter, Instagram, wherever, and this is a business that manages that globally across big companies.
Can you guys, touch on overlap between the small cap funds and how you might collaborate on ideas? Ideas might go from one to the other.
It's about 35%. I think I just saw it this morning. So, there's some overlap, but it's not overly bunched up.
Yeah, I mean, my fund and Ron's funds are the 2 oldest funds, and there's only like a 25% overlap between Barron Growth and Barron Small Cap. Barron Discovery, we started one of the core reasons to start Barron Discovery was not just because we knew that these guys would be great investors and run a great fund, which is proven to be the case. Well done. But also because I found, and Ron found, that we were gravitating to invest in companies that had a little larger market cap. 2 billion, you know, I was at 2 billion or so, and there's a lot of interesting companies that fit some of our criteria at lower market caps. And maybe those have a little more risk to them because they're less fully developed, but still would be great opportunities to good investors. So conceptually, let's go start a fund with really smart guys to invest in those. Then over time, as some of those stocks grew up, and now we're 10 years in, many of those holdings have migrated into the small cap fund, and that's why the overlap is 35% that Randy just said. And then, you know, we're friends and we respect one another. And if I have we have a great idea that we think is exciting, we're sharing that with Randy and Laird. They're doing the same, and so we don't really. The overlap is a good thing. We don't step on each other's toes. It's easy for us both to operate in a stock, and if we're both involved and both looking at something, actually, I think the dialogue between us is going to help us make the best decisions.
Great. I think another question, which I think really touches on why we are special and different, but it's saying, hey, you guys, consistently outperformed over multiple time frames and don't, necessarily sell out of things that are underperforming. How does that work? And I think, again, that's probably speaks to our long-term nature. It's different than other folks who are constantly trading the portfolio. Another question next to that about sell disciplines. So, maybe anyone want to touch on both of those?
Just a quickie. We do sell out of stuff that's not performing. So,
Yeah.
last year we're
like
going
everyone
to,
else.
making mistakes, or we don't, we lost confidence in this manager, or this business is not developing as we thought, or, I'd say had 60 stocks, we sold 5 in total last year, where we kind of said this is not working, and where we got something better to do that we want to do. So, I use this phrase and get made fun of, but you kind of water your flowers, which means if the ones that are working as companies, and they're usually going to be working as stocks, water and try to stay in those, but you got to cut your weeds also, meaning you got to the companies that you hoped would succeed over the long period, when they don't, be honest with yourself and say, nope, this isn't what I thought it was. This isn't as good as what we can find, and let's move on from this. So yes, we hold the good ones, but we don't hold all of them.
Yeah, and I'd say just our biggest risk mitigator is knowing our businesses as well as we can. Staying in that constant interaction with management, that's our advantage, to have that access, and we use it to check on milestones and make sure the thesis that we initially invested in is playing out. And so we've held stocks for 10 years. We certainly can check those motivations and what those businesses are doing.
I would make one more point also. We take advantage of liquidity both in good times and bad times. So valuation is really key when stocks get super extended. You can, and you think people are overvaluing for the long term, not the short term, for the long term. You can trim into, but more importantly, if you make a mistake, sometimes that gives you the opportunity as well, because you get a market sell-off. But everybody makes mistakes. You can't be perfect in this, and the key is risk managing and making sure the position sizing is right. And as Cliff said, when management disappoints or the thesis isn't there anymore, that you sell.
And this question is kind of touching on managing your best performing stocks. In a nutshell, it asks about, do you sell at certain market caps from technical perspectives? How do you manage your largest winners?
There's no fixed market cap to sell. I think that would be silly, because, as Cliff mentioned, you catch a tiger by the tail. TransDigm, 18 years. I can't believe it. I was the analyst on the IPO for that thing, and it's been just unbelievable. It was 153 times your money on that one.
Yeah, and
amazing.
bought it at $1 billion, and it's got a much bigger
It's
market
much
cap.
bigger.
Yeah.
Like if Cliff was forced to sell at 10 billion, he would have missed all those baggers.
It was one of our best performers last year.
Yeah,
So why miss out on that performance
last
by
year,
being
in
forced
year
to sell?
17.
Yeah.
It's crazy. It's so great. And but the key is balancing the overall market cap of the portfolio and the size score. Make sure that it maintains that small cap character across the portfolio.
And maybe you want to just touch on we are attuned to that. Obviously, TransDigm, we own 5% of our peak position. So that, we own 100,000 shares. We used to own 1 million shares. 2 million shares. So we we certainly manage that position sizing.
You give the tickers of your funds.
That's an easy one.
Question. Davey?
BSCFX.
BDFIX. Okay. Thank you. Kinsale? Any comments on Kinsale?
They're really, really good.
Why are they really,
Thank
really
you.
good?
Yeah.
Thank you.
So Kinsale sells into the E&S market, which is the excess and surplus lines insurance market. The analogy I always use is it's kind of like the over-the-counter market for stocks. So you have the standard market, which is the standard contract market, which is kind of like the exchange-traded market of insurance policies. But what's great about E&S is that you can write each individual policy for each individual risk. So they're very personalized and structured. And the reason why Kinsale has been such a great stock for us, or one of the primary reasons, is when we got involved with it, it was a soft market. Since then, we've transitioned from what is a soft market to what is a very hard market. We've seen excess and surplus lines as a category take share from the standard market. And Kinsale has taken market share within the E&S market. We also just think it's a well-managed business. They manage their risks better than their competitors. And we've seen earnings growth and growth in book value as well increase at a rapid rate over time.
Yeah. Another question, the outlook for the long term in that insurance market?
So let's put it this way. We are certainly modeling moderating growth.
From 40% to 20%.
Yeah.
40 is crazy.
Right.
Yeah.
And so, but that's in our numbers at this point. And the P multiple and valuation targets that we're using reflect that slowing growth. But I'll tell you that we were modeling this 2 years ago, and so far our numbers have been too low now for 2 straight years. So we don't know when it'll slow, but we certainly are trying to be conservative in our outlook.
And I would, if you don't mind, I would also add the E&S market is a small percentage of the total market. I think it's only 1% of the P&C market. And at our conference, Mike Koch, the CEO, spoke and mentioned they pass on 9 out of the 10 deals they look at. So there's just a massive opportunity for them to continue to grow, and that competitive advantage is sustainable because of their technology and their speed to make quotes to their broker channel. So there's a real advantage there in that business, though there's a long runway for growth.
Back to the collaboration between funds.
Yeah.
This was a early and very successful investment for the Discovery Fund. We didn't own it at first. After watching how well this company was doing, learning about it from Laird and attending meetings with Mike, the CEO, prior to ownership, it's like, we were fortunate to join in and have a significant important investment in this fund, in this stock as well. Thank you, Laird, for bringing that to our attention.
Yeah. So another question popped up about GLP-1 drugs. How are you thinking about them, and any impact on your stocks? Any?
I guess I could talk. I mean, it's going to be the biggest drug class ever. Some of our analysts are talking about this could be a $100 billion market. I mean, it's multiples of what statins were at their peak, which were statins are cholesterol drugs. It affects healthcare in a lot of ways. We have to think about knock-on effects to some medical device companies. I think you guys own Inspire,
Yeah.
Which is a sleep apnea company. There's a study that's going to come out based on to GLP-1s reduce sleep apnea. So obviously that would lower demand for medical devices, but there's a lot of reasons why Inspire should be fine, even if that's the case, having to do with different levels of obesity and what the overlap really is in these patients. So that requires a lot of detailed analysis, and which we do very well. And so we're mindful of, we're not investing directly in GLP-1 drugs. We own in Discovery a company called Stevanato, which is a manufacturer of specialized glass vials and components for the injection pens for, we believe it's going to be Mounjaro and Zepbound, two of the key drugs. So they're building out a massive facility in the Midwest and one in Europe to increase production of this. You can't get these drugs. It's really hard to get these. There's so much demand for it. So we believe, that Stevanato is very well positioned to grow over the next few years and also take advantage of the increased overall biological, availability of drugs.
These drugs wreaked havoc on small cap stocks all over our portfolio last year when Laird, we both own a stock called Utz, which makes potato chips, and at some point no one's going to ever eat a potato chip again, and therefore the value of that stock fell 50%. But there was a lot of knee-jerky reaction last year, winners and losers of GLP-1s. Many of the losers, we had a handful in our portfolio we thought really weren't going to be it was just a temporary knee-jerk, and their business wouldn't be so affected by it. Now we're a year, now it's 6 months after that, and the stocks have recovered those that really businesses aren't going to be terribly affected. It's good for us, but by not getting freaked out or unnerved by some downward pressure on some of these stocks last year as the market, in our mind, overreacted to stuff, we actually took advantage and were able to add to positions at better valuations on some of the stocks that was our conclusion wouldn't really be so effective.
Can't you just eat a lot of chips if you're going to take that? I don't know. All right, one question on SBA. For SBAC, where do you see the growth coming from?
Oh, it's just a terrific business. It's primarily SBA is a communications towers company. Their business, it's an investment that was one of these big winners in the fund, bought in at a sub-billion-dollar market cap and is a $20+ billion market cap, one of the great stocks for the fund over its history. Actually, business in the questionnaire is probably knowledgeable. Business in this end market is much lower now than it has been. Historically, the business has grown mid-single to high single digits organically, and then EBITDA much faster. Presently, because of churn on some of their towers, growth is now much more modest than that, and therefore the growth profile is less exciting than otherwise. Now, we own sub 0.5% position, so over time we've reduced our exposure to this company because growth has come down. I still actually believe even if growth is more moderate now and its outlook is less than it used to be, the stock will perform very well when interest rates come down. It's a heavily levered business. Their cost of capital has gone up significantly when rates went up. As I said at some other point during this, I suspect that is going to change. And when rates come down, the stock acts very, very well.
All right, we just have a couple of minutes left. There's a question about, do any of you look for a particular catalyst for small caps to do well, and if so, are you seeing it today? Talked a little bit about some things that are very favorable. Is there anything else particular you're looking for?
I think, from my perspective, it comes down to the rate environment largely, and also the people, as the Magnificent Seven stall for some reason, and people feel that they need to shift. Is there some kind of asset class shift? But from as we have mentioned, from an absolute and relative basis, small cap is the place to be right now. We think. So, it'll happen. We don't know when.
We don't invest in the stock market. We're investing in a market of stocks. So we're not investing in an index, a small cap index. And now it's good to be active because 20 to 30% of the index is not profitable. But I will give you one fact. Just after the first rate cut, small gains nearly 11% and has outperformed large 9 of the 13 times the Fed cut rates going back to 1957. So maybe that's a catalyst.
That's great. Thank you. I want to thank all of you for your time today and your comments. It was great, very insightful, and certainly small caps, I'll reiterate, are over the long term alpha generators and risk reducers in a diversified portfolio. So hopefully everybody revisits their asset allocation, keep small caps in mind. With that, I'm going to thank you all for investing and joining today. Please fill out the surveys that'll pop up, and thank you again for joining us. That concludes the webinar.